Today we will learn how to enter orders when the market is sideways, which means moving sideways. A sideways market is always a big headache for traders because most orders easily face drawdown. In reality, there is currently no theory that can accurately determine when the market goes sideways. But to make it easiest to understand, we will use the bull and bear law using the market nature of buying and selling to explain. For example, currently we have an upward wave of the buyers like this, then the sellers push it down and the buyers continue to push it up. If the buyers continue to push the price up, it will create a bullish structure, breaking the peak upwards. However, if the buyers fail and get pushed down, and if in this case, it breaks through the bottom here, it starts a structure breaking the bottom, which shows the sellers beginning to take control. So, if it does not break this bottom now, but then turns back up like this, then both buyers and sellers fail to break the peak and the bottom to create a bullish structure or a bearish structure going down. This phase does not show complete dominance between buyers and sellers, and therefore the sideways market will begin now. We will not have an exact definition of a sideways market. However, with the naked eye, we can see that a sideways market usually starts when both buyers and sellers fail. Thus, we will usually have at least 2 peaks and 2 bottoms. This example is an ideal case, which means it moves sideways in a rectangle with 2 equal peaks and 2 equal bottoms. In many cases, it can break above the peak a bit and then break below the bottom a bit, then continue to bounce back. This is also a sideways market. So that is the identification feature that we can most easily imagine when a sideways market begins. Now we will look at a specific example. And here we see a clear bullish structure, and this wave segment just broke the peak upwards. Now we will continue to observe when the price starts to move sideways. Then we can see here at this peak area, the second failure of the buyers when the price rises. The sellers rush in to push the price down the first time. After that, the buyers try to break through this peak to create a further bullish structure. However, the sellers continue to rush in and push the price down. The price is then pushed down, and when it reaches the support area of the buyers continue to rush in and push the price up. So this period is likely the beginning of a sideways market when the sellers fail and the buyers also fail. We will form a sideways price zone, which is these 2 zones, an old resistance zone of the sellers and a support zone of the buyers. The more the price reacts at these zones, the clearer the sideways trend becomes, and we will see the price move sideways more. However, our goal is to identify the sideways trend as early as possible. Knowing the signals that start the sideways trend will help us easily avoid a sideways market or find good entry points when the market starts moving sideways. Let us continue to observe. Here we see when the price reaches the resistance zone of the sellers, they continue to rush in and push it down. However, the buyers then push it up and break through this zone. When the price breaks through this zone, it shows a bullish trend again, therefore the sideways trend will end. Now continuing with this case, we can also see the price pushing up. Then the sellers rush in and push the price down, the buyers continue to push the price up. However, in this case, before the price reaches this peak zone, the sellers push it down early, and then the buyers continue to push it up to the old peak zone, and the sellers rush in again to push it down. So at this point, it has also started to form a sideways trend, because there are multiple failures in breaking the peak areas upwards and breaking the bottom areas downwards. We will have sideways zones like this that we can draw because it has a very long period of moving sideways and it has not broken through these 2 zones yet. It can even be sideways zones within sideways zones, meaning it creates smaller sideways price zones inside larger sideways price zones. Normally during sideways price periods, the price moves unclearly, and it can sweep up or sweep down, showing no dominance of either side between buyers and sellers, until a strong wave pushes up, breaking through the upper sideways zone, or a strong wave pushes down, breaking through the lower sideways zone. Only then does it show the dominance of one side. In addition, we need to pay attention to another thing, which is the amplitude of the sideways market. The most important question we need to determine is which side is currently stronger between buyers and sellers in the current market. If the sideways amplitude is too small compared to the previous bullish trend, it barely affects this bullish trend, and at this time the buying force still dominates. However, if the sideways amplitude is larger, it will have more influence on the previous bullish or bearish structure, because we clearly see that the sellers are entering more now and pushing the price down deeper. Now we will look into a specific example so you can easily visualize it. This is the AUD-GBP pair on the M15 timeframe. Many of you might wonder why I mainly use currency pair charts. It is because the currency market is the market with the largest trading volume among financial markets. It is like the playground of the biggest sharks of banks, of governments, of nations, so its liquidity is very massive. In stocks, price data in a day is only from 9 a.m. to 3 p.m. and crypto liquidity is not equal to it either. Specifically now, you can open any coin on 2 different exchanges, then turn on a small time frame, like M1 or M15. You will see that candlesticks differ a lot across different exchanges. However, if it is a small time frame between 2 Forex brokers for the same currency pair, the difference in candlesticks is very minimal, which relates to liquidity. Therefore, if you can conquer the Forex market, the remaining markets will be much simpler. We will return to the example of the period right before, where we can see the price rising very strongly. Then the sellers rush in to push the price down and create a bearish structure like this. When zooming out the chart, we see a fairly strong bullish trend. However, if we zoom out further, this segment actually lies within a sideways trend around this area. Zooming out like this is just like viewing a larger time frame. For example, if we switch to the H1 time frame, we will see a more comprehensive picture where the price moves sideways within these 2 zones. Or on H4, everything is much clearer here. Or if we open the D time frame, this area is no longer a clear sideways zone but is still leaning towards a bearish trend. Thus, you need to note that all definitions of trends or structures should be considered as a supporting or non-supporting factor for our trade, and we should not view it as the most important factor to spend too much time on. As you can see, a small price segment here only represents a very small part of a previous bearish trend on the D time frame. However, when switching to the H4 time frame, it becomes a clearer sideways trend where we can draw these 2 zones. And within this sideways trend on the H4 time frame, there appear bullish or bearish structures on smaller time frames like M15. Thus, a bullish trend or a bearish trend can just be part of a sideways trend, or even a sideways trend can be part of a bullish trend or a bearish trend. Guys, part 1 ends here. Don't forget to hit the like button and leave a comment below about the trading topics you want me to cover next. I also regularly share real-time market insights and high-probability setups inside Rocky's room, so feel free to follow along and stay connected.